Welcome back, everybody. So one of the things I try to do on this channel is explain to people how I approach a problem, how I analyze data. And one of the things I try to analyze very closely is economic data, because we watch the news and we all hear different interpretations of what's going on economically. But I like to really try to understand it. So I want to dig into it because it affects my family, your family. I got kids going off to college in a couple of years. All this is important. So I wanted to go through some of what I've been trying to figure out. Is the economy getting better? Is it getting worse? Is it just going sideways? What's it all looking like? There's a whole playlist on my channel when I've gone through cost of housing, cost of cars, all kinds of different things. But one of the things that I think is driving everything getting far more expensive, whether it's the cost of a car, what's the cost of a house, just borrowing money, just day-to-day lives, where's all of it kind of falling off the rails? I think I finally figured it out. So the money supply in the United States is made up of various components. M1 is the money supply. That's currency, demand deposits. Those are, things like you just go to the bank, use your debit card, pull it out of your savings account. Boom. That's, sort of money you have stacked in the other room, whether the $50 you have in your wallet, that kind of stuff. M2 is the money supply, including cash, checking deposits, which are handled a little bit different than M1, non-cash assets that can be easily converted to cash, the stocks, those kinds of things that can easily be converted. We're not talking about like a privately held company here. We're not talking about like your house that's not easily converted. That takes a little bit extra time. Things you could go and push a button and get the cash in a day or two. That's M2. M3 is longer term deposits, institutional money market funds, short term repurchase agreements, debt, liquid assets, those kinds of things. So, call term borrowing. These are different larger companies borrowing money to go off and do things. Saving deposits with banks, currency with the public. It includes all the other components. So when you see M1, it's actually everything in M2 plus some additional stuff. So when you see some of the same things here, it's really just because M3 is M2 plus these other things, right? So the M3 money supply is really what sort of matters. Actually, all of them really matter, but the M3 is one I want to focus on because it's the one where it's kind of the least easy to hide what's going on. So let's look at the M2, M1 money supply over time. This is direct from this definition is direct from Investopedia, but this chart is straight from Fred. That's the Federal Reserve Bank. So this is the Board of Governors, the Federal Reserve of the United States published this chart. You can download it for free. It just Google St. Louis Fed and this will be what pops up. But if you look at this chart, the money supply in M1 has had a few spots where it kind of bumps up and down and then it kind of takes off like a rocket right around COVID. But the slopes of these lines are what matters. But let's look at a couple of things before we dig into that, because these other things matter. So notice over here, you've got this weird little thing where it sort of the slope of the line changes and then it kind of goes back down, and that'll become important in a minute. But just remember that, and we'll show it again. Doesn't matter. M2, same kind of thing. It skyrockets, but not to the same extent because it already got covered in the other chart, and it kind of smooths out. So you see how this is a little bit smoother than the other one. That's why it's important to look at all these, because one thing doesn't show you the whole picture. You want to get the big picture. Looking at one piece of data or another doesn't really tell you everything. And when you talk to the local news agencies, they have a tendency to show this one because it's more fun to show things going up in crazy lines than it is to show things looking like that, right? So they tend to manipulate data a little bit to make it look different. That's important also because you always want to understand what data it is you're looking at. And like I said, you can download this data for yourself and look at it all day long. But also notice here, this is M3, which is everything in M2 plus repurchase agreements, larger liquid assets, certificates of deposit, that kind of stuff. These are corporate agreements in between one another. My value of my company is a private company, so it falls in here somewhere. It might fall in M4, but this is sort of bigger assets that aren't long-term, that aren't just instantly liquefiable. And you'll notice the numbers here go way up. So if you go to the previous chart, that was kind of the same scale, but this one's, this is a little bit different piece of data. So what this one tells us is something a little bit different, but look, the kind of gets a little bit smoother. So, but let's focus in a little bit more on that M3 number because it's sort of got all encompassing everything thrown in a pile. Now, if you look at it just sort of like this, you're like, wow, it's gotten a lot worse since 1965. Well, this chart has these little grayed out areas that are major events that took place, and those become important in a bit as we focus in a little bit more. So that's M3. Now, here's M3 where I've circled some stuff. I've kind of focused in because if you remember back over here, this goes a little bit further back than it does over here. I've kind of focused in a bit because it's important to note these little spots where the slope of that line changes. So you see the money supply is increasing. This, by the way, is right around where we came off the gold standard. So coming off the gold standard actually changed a whole lot of attitudes towards the money supply, and it sort of ushered in the era that is now sort of referred to as modern monetary theory. It wasn't really called that back then, but it is now. But that becomes important in a bit. So this line right here, this circle, is an S&L scandal. This is another S&L scandal where banks were about to fall apart. So what they did was they changed the money supply. So you kind of the slope kind of changed. This one, it kind of decreased a little bit. That's actually a good thing. Here's the dot-com crash, where a bunch of things fell apart and banks were about to, again, take it because they'd all invested in dot-com companies. Well, you had to fix it, right? So the money supply, that slope of that line, the amount of money supply increase over time changes. So the slope is important here. And to a physicist, what that means is how fast does that line go up for a period of time, right? So a small slope when it comes to increase in the money supply means the opportunity for inflation is far less. So that slope is important. And you see how it increases a little bit there, it decreases a little bit there. The dot-com thing happens where everything crashes and it increases again. And it kind of stays sort of steady until 9/11 happens. And then it increases a little bit, not terribly much, but it does increase. You can kind of see it happen right there. That's the war on terror. But it doesn't ever really come back. It came back a little bit, but not too terribly much. And then we have the 2008 housing crash, where we just about destroyed the economy because everybody was doing these derivative bets and handing out these risky, ninja loans or no income, no, you basically have a pulse and you can get a mortgage. And then companies were buying and selling those mortgages to each other and people made bazillions of dollars. And then we almost destroyed the US economy because, well, it turns out making really risky loans come with a risk. And the more risk you take, sooner or later, it comes crashing down. But to fix it, they changed the money supply again. So see, there's that slight spike and it sort of kind of does okay, but we were having some economic problems right around there. So it went up again. And then that slope sort of stays the same right up until COVID. And then it is off to the races, right? And even if you look through this time period instead of right when COVID happened, it's a lot bigger slope than here. And right around here, it started coming back down for the first time in notable history. But what happened right there was inflation. We were all seeing double-digit rent increases. Grocery store prices went freaking nuts. All kinds of things went insane, right? So now, if we look at this chart right here, this is the federal funds rate. This chart represents the amount of interest a bank has to pay to borrow money from the Federal Reserve to go off and loan it out for things like mortgages and cars or credit cards or whatever. Or if you're a hedge fund, you can borrow money and go put it into the stock market and buy a stock based on this interest rate. So this is percent interest that they're paying. And if you see right here where it spiked in this huge number, this was the 70s had sort of runaway inflation towards the end, right? They just these nutty inflation numbers. And to bring it back under control, they had to raise that Federal Reserve rate to get that money supply problem taken care of. Now what they've done is all these little lines, all these circles I've lined up with that other chart, and I'll show it all together at once. But if you look right here, every time there's a crisis, lower the rate. Okay, a small crisis, lower it a little bit. Another crisis, lower it. Okay, then you start to see inflation rearing its little head. So you start to raise it a little bit to get that money supply back under control. Then you lower it, and then you keep it low for a really long period of time because the housing market kind of was destroying everything. So we took it down and said, let's rescue the banks, right? But you rescued the banks at a way that said, hey, let's just inflate the currency. And that's okay. But inflation wasn't too terribly bad, right? Because we were all still trying to recover from this mess. And it stayed that way for a little while until right around 2015, 2016. Then it started to creep back up a little bit. And then right around then right around COVID, we decided, nope, this is Trump took office right around here, and then it went down because for whatever reason it went down. And then of course COVID happens and it went to basically zero, and it stayed at zero for a period of time. And then inflation started to hit again, and we've got to raise it back up. And now what you're hearing is, well, the stock market went down. We've got to go lower that Federal Reserve rate to go help the market. Well, the reason the stock market went down was when this rate went up, the larger funds that were investing in the market to borrow money to do it, to leverage their assets to do it, they were borrowing it from Japan, because Japan kept a low rate. Well, Japan raised their rate, and next thing you know, it has to go sell out of the market because that interest rate went up, and they had to go cover their loan with the Japanese. Well, same thing here. Now they're clamoring for it to come down, but if it comes down, inflation comes back. So what we've done is we've kind of normalized, and here these are lined up. So that circle is that circle, that circle is that circle, and so on. So what we've normalized is saying, okay, well, the moment banks right here, right here, right here, right here, right here, moment banks start to get in trouble, we lower that rate to go save the banks. But what that does is that puts inflation over onto the people that wind up having to buy things at the grocery store, which is basically everybody. But it really is sort of a regressive way of sort of saying, okay, let's make sure that we are going to cover the debts, especially of the United States or the banks or people who took large risks, by loaning the money at a lower rate and pull that money back out of the economy or inject more of it in. And the more of it you inject in, the more inflation you've got. So you have to pull that money back out once inflation starts to rear its ugly head, which right here is where inflation started. Right here is where inflation started to rear its ugly head. So, of course, right there is where we raise those rates. Well, now they're saying we got to lower them. Well, inflation's kind of gotten under control, right? But now we're about to have this sort of unemployment rates are going up. So everybody's like, oh, there might be a recession. So we got to go lower rates to go pump up, banks and pump up financial institutions. So what this really says at the end of it is, is our economy based on anything other than just massive piles of debt? And the only way our economy seems to have life breathed into it is when we're running up massive piles of debt. And it hit me. I'm like, well, gee, that's kind of an interesting notion, because I ran a video a while back on housing prices. And if you go look at that video, you'll see that there were a couple of spots where housing prices spiked. But the interesting thing about it is that if you really look at it carefully, you'll see that housing prices really kind of went on an extreme change when you had the Federal Reserve kind of lowering rates. So you see these spikes kind of line up with the other ones. Well, housing prices went up because we were able to borrow money cheaper. Well, that's on the same playlist as this video, so you can take a look at it for yourself. There is one other chart I want to show you that I think is very important because it allows you to look at things interactively. It's on a website called Y Charts, which is a very interesting website that will pull data from different places and allow you to build these interactive charts. This is the M2 money supply, where you can see from 2020 through 2024, it's gone from 15 trillion to $21 trillion. So that money supply has gone up, but we've also had a lot of inflationary problems in there. And inflation is starting to kind of look like it's under control. I did another video on that you feel free to go take a look at, that kind of explains how they've got the inflation numbers under control, because they kind of cooked the market basket of goods to be sort of weird. But you can redisplay this yourself. So if you look at it across the last 3 years, the money supply started to come back down, but that's right when we started getting inflation under control. But now the money supply is starting to go back up. And, sure enough, right around that same time, I'm noticing prices are going back up. So, if you look at it even in the 1 year chart, around September last year, it was $20 trillion. Now we're back up to $21 trillion. That money supply matters. It's what's going to make the difference in between a functional economy for people who live paycheck to paycheck, or do we just blow up the Dow and make sure it goes to Dow a billion? Well, Dow a billion doesn't mean what it used to, right? And the question is, where do we put that sort of who's going to feel the pain? Because if my math is correct, it looks like there should be about a 15% tax just sort of added on everything to deal with the federal debt and deal with state debt and deal with other debts that are out there. But we can't put a 15% tax out there because that would destroy a whole lot of people. So what we're going to do is decide, we'll just, print 15% new money every year. And as soon as that inflation thing starts to hit, we'll raise rates for a little bit. And then as soon as the Dow starts to take a hit, well, we're going to go fix that, right? So I think the problem we've got is our economy got broken somewhere between sort of 1970, when it came off the gold standard, and right around the time, I think the real breaking point, it was sort of getting broken. It was taking hits. It was being wounded with all those little circles. But I think the real hit was 2008. I think that's when it was just like, okay, I'm going to bust it apart. And all we did was say, okay, we got to do something. We can't let everything fall apart. So we're just going to go rescue the banks and just sort of hope for the best. And now the answer every time is, hey, let's just lower the rate to borrow money to zero for the big guys and just kind of hope for the best. Well, that doesn't really work long term, right? So where is that economy going? And can you continue to keep those rates low? Or do you have to get some kind of an interest rate out there that sort of works to kind of balance keep those balance sheets normal? Because if I'm a business owner and I want to expand, and I can take a risk and say, hey, look, I want to borrow $1 billion at 1%. That's a whole different equation than me borrowing $1 billion at 5%, right? So you keep those numbers to the point where they're rational and not insane. But at one point the Federal Reserve rate was like 0.1% or something. It was nutty low. So if you're a big business or a bank and you can borrow money at 0.1%, where's the risk to you to loan it out to anybody? Which is where sort of that problem comes in, right? Remember the ninja loans, right? It was essentially we're just kind of, hey, here, have some money, anybody who wants it. Well, it doesn't work. Right? Sooner or later, you got to get that monetary policy under control. Otherwise, all you're going to wind up doing is just increasing the money supply. Yay, no problem, right? The Federal Reserve can just pay off the national debt. We'll just create new money. Boop, there you go. But is that the right thing to do, or does that cost, take the price of a gallon of gas and turn it into $10? So you have to really kind of look at how these things balance out. And I think if you look at all the videos I've done on my channel, kind of talking about different events that have occurred and what impact that has had on everything from house prices to car prices to the cost of paying a credit card, which is now in the high 20s. If you have one, unless have a perfect credit score, which is great for you. But if I don't have any credit card debt, so it doesn't really bother me. But the point is that to keep things moving, we've had to kind of go nutty with this borrowing money. And if you look at the numbers on consumer debt, they're at all-time record highs. If you look at which is credit cards and car loans, if you look at the number of car loans out there, we're at all-time record highs as far as dollar values goes. If you look at the amount of mortgage debt, we're at all-time highs. The amount of debt that's running the economy, not just at the federal level, but at the commercial level, is insane. And the reason that pile of debt keeps expanding is because the interest rates are shockingly low, so nobody pays cash, which kind of makes economic sense. But at the same time, what it's done is it has also inflated the value of things to a point where it kind of doesn't make sense on occasion. And if you look at those other videos on the channel, including the price of homes relative to the average income or the price of a car relative to the average income, I think you'll see what I'm talking about, where things have gotten far more expensive as compared to what the average person brings home. And the reason it's gotten more expensive is because we continually expand the money supply, and it makes it look good because it's not a tax. But at the end of the day, it's still painful to people in the bottom 2/3 of the economy, which is why the number I pulled earlier said 60% of Americans have less than $5,000 in savings. And that's a scary freaking number when, any trip to the dentist could cost you $4,000 if you don't have any insurance. So, and before you say, oh, well, everybody has insurance because, we mandated that. Great. What's your deductible? What's your annual deductible? Tell me that one, and then we'll have that conversation. I'm going to keep digging into these economic things. I hope everybody likes the analysis. If you want to argue the analysis, if you think I'm looking at it incorrectly, drop me a line. I'm happy to discuss it calmly and rationally with anybody. And I will discuss it at length with anybody who wants to have a rational discussion. If you want to come on and yell, I'm probably not going to do that. But everybody have a great day. Click like, subscribe, or follow wherever you see me. And I hope the summer heat breaks soon, because I live in Dallas and I really hope it does. It was 103 today. Everybody have a good one.